The company reporting season continued today with Australia's biggest retailer, Woolworths, leading the way, and it wasn't pretty. Woolworths lifted full-year earnings by 5% to $2.1 billion, but predicted growth this year could halve. Shareholders reacted swiftly, wiping 6% off the value of the company. Tracy Kirkland reports.
In a year when consumer confidence took a hit and wild weather affected much of the East Coast, supermarket giant Woolworths has made an after-tax profit of $2.12 billion. That's up 5% on the previous year.
This year we faced both challenging macroeconomic conditions and Mother Nature threw a few wobblies at us, both in Australia and New Zealand, but despite that we delivered yet another positive overall result.
But that wasn't enough to calm investors, with shares plunging 6%, finishing the day at $25.75. Their concern, the company's forecasts for this financial year.
Woolworths is guiding to 2 to 6% EPS growth, and the market was really at a number closer to 7. So I think that's where the disconnection between what they've said and expectations has occurred.
Woolworths is blaming continuing soft consumer sentiment, as well as the cost of setting up its new home improvement chain Masters, which is expected to hit next year's profits by about $100 million.
When you start up a new business, there is costs, so costs of setting up new distribution centres, the central team, opening marketing expenses, training of people, the cost of the inventory before we open the doors.
And I think Woolworths are investing a lot of good money behind this home improvement division, and they are yet to earn a single dollar from that. And there's a lot of risk going out and directly competing with Bunnings, which is miles ahead.
And in stark contrast to many of the mining companies which are recording massive profits, retailers face a rocky road.
I think for Woolworths in particular, I mean, it's just standout performer in the past. For them to be struggling is telling you that the consumer environment and the retail environment is very difficult at the moment.
It wasn't all bad news. Woolworths hotels and online shopping recorded significant increases.
Our online sales for the past year up 63%. Dan Murphy has been launched and has been a tremendous success. Big W continues to grow week on week on week.
Elsewhere in the retail space, distribution company Metcash has won its bid to buy supermarket chain Franklin's. It already owns IGA, so the Australian Competition and Consumer Commission took court action, fearing the sale would give Metcash a monopoly on grocery wholesaling in independent supermarkets. But the federal court didn't agree. In a statement, Metcash says it is now free to acquire Franklin's, which comprises 80 corporate stores, plus supply to 10 franchise stores, all of which are located in New South Wales. It seems it has plenty of support.
The stronger that we can make a third force in the grocery space, I think that will be better for our suppliers longer term. But we really need some rational pricing to come in. People need to realise that it costs money to produce milk, it costs money to produce cheese. And if people want the range, and if people want good quality products and innovation in their products, we can't keep screwing the suppliers.
Metcash finished up 1% at $4.11.